Good morning, everyone. This is Matt Tooher with Insurance Agency Marketing Services. I'm on the annuity side with IAMS. Glad you could join us this morning. We're going to be soon to be joined by Ryan Haezebrouck and Craig Geiger. Ryan is from BlackRock, a great financial institution, and they're a worldwide company. Ryan's going to have some excellent information to cover for retirees, what they need to look for in retirement, good ways to keep their money safe in this crazy stock market environment we're in right now. So definitely a good time to get some money into safety. And we're also joined by Craig Geiger, our regional rep from Lincoln Financial. Craig's been in the annuity business for many years, and he has a great expertise on the indexed side of the business. So he'll be covering some items of interest from Lincoln. And this is Matt Tooher. I've been at IAMS since 1994, probably before Craig and Ryan were both born. So I've been here a long time on my end, and seen a lot of changes over the years. When I first started, it was all fixed rate annuities. Now it's pretty much all indexed annuities. We are seeing a little resurgence right now on fixed rates based on the environment we're in, but things do continue to ramp up on both the fixed and index. We're seeing a definite increase in business this year with the market volatility. So a great opportunity to take advantage of some options that are available on the fixed sides of the market on safe dollars. So we have a lot of opportunities with IAMS regarding earning some additional money based on business in the first 180 days of being contracted. We can help you with advertising monies, help you with other activities based on doing seminars. Maybe you want to do a radio show. We have a lot of options you can choose from based on different levels of production through IAMS in your first 180 days. Great options to choose from based on if you have interest in doing a radio show, maybe you want to do some mailings, maybe you want an iPad, a lot of different items you can choose from based on your level of production there in the first 180 days of being contracted. We also continue to offer a referral program. You refer agents to IAMS. You get $50 when they get contracted. You earn a override based on their production. On index annuity production is 20 basis points. On multi-rate guarantees, it's 10. And you can earn some really nice monies on that. I know I have agents that call me every quarter wanting to know when the checks are going out. And they've referred some really nice producing agents to us. And they have some really nice checks heading their way on a quarterly basis. A great way to fill their pockets based on those referrals. We also do marketing reimbursement. Reimburse $100 for every $100,000 of annuity premium that you write, and based on life premium, it's $200 for every $100,000, and then for target premium on life, it's $200 for every $10,000 of target life premium. So those checks are cut is when you send in your receipts for marketing, reimbursed half your cost. So if you send a receipt in for $1,000, we reimburse you $500 of that based on your marketing balance. We have a great back office team here at IAMS. We've got a great group of individuals on both life and annuity marketing, lots of experience, and we have a lot of great support on the new business team, creative team. There's some really good stuff we can help you out with on both ends. I know on the new business side, we are utilizing Firelight. It's an e-app system we have available through our website. I know Lincoln Financial utilizes Firelight. It's a great way to get applications in a clean and efficient manner, and a great way to maximize the speed on the backside of your application process. When you submit the app, we see these e-apps go through in a much quicker time period. So no misspelled names based on handwriting. All the forms have to be filled out, so there's no missing pieces on the application. And then, of course, getting those apps in and get them through the suitability process as quickly as possible definitely helps with the that e-app program. As I mentioned, we do have a great creative team at IAMS. We have a number of individuals that can help you out with creating new websites, doing advertising, maybe want to do a digital marketing campaign on social media, maybe want to do some emails, a lot of great stuff you can utilize here through the creative team, through IAMS. I know that we do a lot of logo designs, business cards, newsletters, postcards, a lot of great stuff you can take advantage of based on that group of individuals. We have a great website you can go to. It's our www.iamsinc.com website. It's been up for a number of years. We have retooled it in the last couple of years. I got some great stuff on there you can utilize based on looking up rates, maybe trying to find out who's going to have the best income based on the situation. We utilize the annuity rate watch. The rates are updated on a daily basis. You're going to look at who has the best 5-year fixed rate in New Jersey. You can look that up, find out what companies offer the best rates that IAMS offers, and then also look at indexed annuities, who has great cap rates. I know Lincoln Financial has really bumped their caps up on their participation rates and cap rates on their indexed annuities. Very strong right now. We've been seeing some good business heading that direction, so we appreciate the help on rates on that side. And we probably going to see rates level off. I know we're starting to see the 10-year T-bill kind of level off and actually go backwards a little bit on rates. So we'll see how that goes the next couple months. We have a really nice software program you can utilize with clients called the Retirement Analyzer. It's a program that prints off some great reports for clients, takes a look at where kind of they stand now for retirement, what they need to save the next year, 2 years, 10 years based on their future needs. You can plug a lot of variables in based on hospital stays, early retirement, death situations, nursing home stays, a lot of stuff you can plug into this retirement program, and it's going to kick out some very valuable information for your clients there. We have opened up our wealth management side of the business here. In the last few years, I know that we have seen a nice increase in agents working that side of the market. If you do have interest, I just sent out a quick poll. If you have interest in getting some more information from IAMS on our wealth management team, we'd be glad to get that done for you. We have a great group of individuals on that side that can help you out in the wealth management team. I know that we've got some great platforms to choose from for clients to invest their monies in, and we've got some good money managers that we utilize on that side. But of our top, say 20 to 30 agents, about 90% of them now are wealth secure licensed on the Series 65, and then we've seen a big increase on our agents on that side, just so they can help clients on all ends of the business. You hate to refer a client down the street to another individual and then end up losing that client to them based on they can offer more programs than you can, and you don't want to see that happen. You want to keep things in your house as much as you can. We'll leave this poll open for about another 20 seconds. If you have interest in getting some more information on the wealth management side of the business with IAMS, check off yes, otherwise check off no if you would. We'll have one of our specialists give you a ring the next couple of days on that end of it, and we'll go ahead and see what we can do for you. I know they have a good testing help if you haven't had your Series 65 taken at this point. We have some groups that can help you out in studying for that and getting that test passed and get that behind you. So again, if you do have interest, get your vote in. I'm gonna go ahead and close this up here. Second here, get that closed up. Go ahead and move forward. We also do a Life and Annuity Academy. I know we've got one coming up in June. If you have interest in getting some information on our future academies, we'll probably do 2 more at the end of the year. Probably do one in Omaha at our home office sometime in September, October, and then we'll do one more probably in Des Moines on the other month. So we're just getting these finalized. If you're interested in coming out to one of our academies, it is a 2-day meeting. We typically hold it in Des Moines or Omaha. It's all expense paid. We take care of your transportation, your lodging, your food. Everything's taken care of. We have some great speakers we bring in. Great, some of our higher producing agents come in and go over some of the things they do in the field to get you in front of more clients, close more sales. We do a round table with them. You can bounce questions off them, kind of really go back and forth on on what they can help you out with on that side of it. If you do have interest, check off yes. If not, check off no, and then we will contact you in the next few days and kind of go over our schedule, what we're looking at in the fall months for some of our fall meetings, and then we will keep you posted based off there is any openings that come up in June, and it should be a really good meeting. We got some great talent coming in on that end of it, so we'll look forward to that situation. I'm gonna get that closed up real quick. Move forward. We do offer a trip. We have an 18-month qualification. I know we recently changed the location of this year's trip. It went from Eastern Europe. We had to change that based on the conflicts on that side of the world to a more local location. We picked the Greenbrier in West Virginia, really a very nice location in the hills of West Virginia. They got great golfing, great outdoor activities, beautiful location there in the hills of West Virginia, some great lodging there. But that is going to take 4 million points now. We dropped that from 4.5 down to 4. I know we're probably end up with about 60 people that qualify. They can bring their spouse, significant other, and it should be a great trip had by all. So that qualification runs to the end of June, and then we'll announce a new location, which will run from July 1st through the end of next year on qualification. So do keep that in mind. We also have we're on Facebook and LinkedIn for some social media activities. We do have advertising on both sides. Good way to keep up to date with what IAMS is doing via Facebook and LinkedIn. Great chance to keep on top of those social media sites. So if you keep that in mind there. On that note, we're going to try to keep this going as quickly as possible today. And I know we're joined now by Craig Geiger, our regional rep from Lincoln Financial. And we appreciate you joining us this morning, Craig, and look forward to many words of wisdom from you today.
No, we appreciate that, Matt, and thanks for everyone for joining today's call. Really today's presentation is really built around the idea that, when you think about what's going on in today's marketplace and all the risks that clients are facing right now, whether it's market volatility, inflation that obviously is at an all-time high, and of course, rising interest rates, which of course we know is impacting fixed income in a big way. In fact, if you look at a 60-40 portfolio, 60% equities, 40% fixed income, if you go back the last 40 plus years, that's averaged about 10.9%. But if you look at the capital market expectations for the next 10 years, it's going to be closer to 4.5%. So it's a significant reduction in return and income, and there's honestly more risk now associated, especially on the fixed income side. And when we look at what's going on right now, the U.S. aggregate bond index is down like 9.1% year to date, and the S&P is down 17.3% year to date. So we know that people are certainly looking for ways to add some protection to their portfolio. And one of the things we wanted to share with you guys today is BlackRock created this really impressive deck of information. And there's also a white paper that everyone's going to get that attended today's call. I'm going to send it to Matt throughout the call, and he'll send it out to everybody after the call. But Ryan, who's a good friend of mine at BlackRock, we've done a lot of these calls together across the country with a lot of groups. And BlackRock, he's part of the BlackRock's retirement insurance group. And what he's primarily going to focus on today is one, the Retiring with Confidence presentation you see in front of you, making the case, for an FIA in a portfolio. Two, he's going to talk about an index annuity portfolio sourcing, kind of looking at an FIA from that vantage point. And also, of course, talking about the mechanics of our proprietary index that we have on our OptiBlend index annuity with BlackRock, called our Dynamic Allocation Index. And so he'll kind of give you guys a little bit of insight on that index, kind of where it's different, kind of where it's unique, and where it's definitely has some differentiators in the marketplace. So with that, I'm going to hand things over to Ryan and kind of kick us off with the Retiring with Confidence.
Perfect. Thank you, Craig. Appreciate it. And good morning, everyone. Really appreciate the opportunity to spend some time with you all today. Obviously, no shortage of things going on in the world these days, so really, appreciate the time. And as Craig mentioned, what I'm going to do is I'm going to walk through our deck, Retiring with Confidence. And this is based on some research that we conducted where we took a look at, an FIA as part of a holistic portfolio construction tool. And this kind of is the next step in some of the research that we've done. Several years ago, we did some research where we looked at a variable annuity within a client's portfolio and what it meant in terms of portfolio construction and what that particular tool on the variable side could do. And we've done the same thing with the FIA in this research, and this is more accumulation focused, but kind of pairs well with industry trends. There's about 70% of the business, I think, going into accumulation focused FIAs, and a lot of that is because many advisors out there are looking for a better proxy for fixed income moving forward. And so, this is a good opportunity to address the risk in fixed income. And Craig gave you some great stats on the 60/40 portfolio. I'm going to add to a couple of those here momentarily. So what we're going to cover in our time here today is BlackRock's approach to retirement. We're going to talk about the retirement red zone and the headwinds facing American retirees. We're going to talk about the analysis and the accumulation FIAs as part of a holistic portfolio construction exercise. And then last but certainly not least, we're going to talk about vol-controlled indices within the FIA space. So let's just talk about, obviously, BlackRock's approach to retirement. The challenge with retirement is, we see a whole lot of headwinds for American retirees. Most recently, we're obviously looking at, the problematic issues with fixed income. If you look at the 60/40, there's some significant headwinds. Matter of fact, your average 60/40 portfolio this year is off to its worst start going back to 1930. And it's roughly about 3 times more risky today than it has been in years prior. And the reason for that predominantly is because of the risk in fixed income, but some ancillary risk as well. So unfortunately, we are staring down the barrel of a pretty significant problem. And what we want to do at BlackRock is help more people achieve financial security and obviously retire with dignity. So a little bit on BlackRock. We obviously are the world's largest asset manager. We manage roughly about $10 trillion worth of assets, roughly speaking. We actually advise another $30 trillion through our Aladdin platform. The Aladdin platform is the brain behind our entire firm. It is the world's most sophisticated portfolio construction and risk analytics tool. We use that to advise over 400 of the world's top insurance companies. 2/3 of those assets that sit on the Aladdin platform actually belong to insurance carriers. We use it to consult with central banks and sovereign wealth funds. We actually helped unwind Greece's debt many years ago. During the COVID pandemic, we consulted with over 500,000 clinicians and health organizations. We work with over 800 family offices around the world, 35 million individuals planning for retirement in the US and Canada, and over 10 million pension savers in the UK. We do all of that on behalf of our clients. We have $0 in proprietary trading, unlike somebody like a JP Morgan who does have proprietary trading that they do on their own account. 2 important points to note here. Number one, we do not buy single family homes. That is not a business that BlackRock is engaged on. That was reported incorrectly on a variety of different news outlets. So we are not in that business. So I want to be clear about that. The other thing I want to address is something that came up yesterday with Senator Ted Cruz's comments about us voting proxy shares on behalf of clients. We do offer that up to clients that we work with. However, we do obviously extend the ability for our clients to vote their proxy shares through our index business. So it is the choice of the client on how they want to address the proxy votes for the shares that they own. So I want to be very, very clear about those 2 things because those have come up. But everything that we do is on behalf of our clients, as we are a fiduciary to all of our clients that we work with around the globe. So let's take another step forward, and we're talking about preparing for retirement. It's getting much more challenging. If you look at, the percentage of employees in their 50s that lack an official source of retirement advice, it's at about 50%. If we look at the difference between the average retirement age and life expectancy, roughly about 14 years. Compare that to when Social Security first got started, and the life expectancy was 2 years. So obviously, pretty significant change there. We're also looking at the difference in a participant's balance after 15 years when retiring with a nest egg of 100,000 at the beginning of a market versus a down market. Obviously, a pretty significant change, and obviously what we've experienced as of late. And lastly, the percentage of retirees that either withdraw money on a as needed basis or do not withdraw. As one person, I can't remember correctly who to attribute this quote to, but decumulation is obviously one of the nastiest, hardest things to do in finance as far as addressing retirement income needs. We're not going to touch on that today, but it obviously is a significant challenge, and a lot of that is because a lot of folks don't have the understanding or the knowledge or the know-how to do that in an appropriate fashion. So let's talk about the retirement red zone and kind of the headwinds facing American retirees. So Craig hit on a couple of good bullet points on the 60-40. Obviously, it's having a really challenging environment. This year, if we look at bonds this year, they are off to their worst start in history, going back to 1926. There's a lot of different headwinds with inflation, geopolitical risk, so on and so forth. And so when we look at the retirement red zone, we're looking at the 5 years leading up to retirement and the first 5 years in retirement, which are a strong predictor of the overall success of a client's retirement. So if you had market turmoil, market downturns, and the client, has their balances in their retirement accounts and their assets depleted in a significant manner, it's going to severely impact the overall success of their retirement. So what we did in our research is we found obviously that the FIAs can allow for the consistent equity exposure in the retirement red zone to help capture that upside potential, while also mitigating downside risk and negative sequence of returns risk and retirement. So there's a twofold benefit here. I'm not going to spend a lot of time on this because we've kind of touched on it already. 60-40 portfolios are under a tremendous amount of pressure. Stock market volatility, stock volatility and valuations are elevated. Bonds are less equipped to provide protection. And obviously moving into a market regime where we're coming right out of an easing cycle and directly into a tightening cycle, we expect it to continue to be a challenging environment for fixed income. And a matter of fact, if we look at the last time that bonds were negative in back-to-back years, we actually have to go back to the 1950s in order to see that. So again, new sources of diversification and return are needed, because the things that bonds were supposed to do, to be a diversification tool, to be a ballast, and to provide a reasonable amount of income, none of those things are holding true in this particular environment. So we need to look at other avenues to address that risk section of the portfolio to help shore up clients' retirement. I'm going to go ahead and skip this particular slide. But one thing I want to hit on here is that equity funds have become significantly more risky today than they have been in recent years. A lot of that is obviously, portfolio managers chasing returns and a lot of style drift that happens with actively managed mutual funds. So you pair that also with the fact that if you look at the S&P 500 in 2020, 62% of the return came from the FANG stocks. So Facebook, Amazon, Apple, Google, Netflix, all of those particular names. And then last year in 2021, the bottom 400 names of the S&P led, the bulk of the return. The problem is that those FANG names represent roughly about 20% of the overall U.S. stock market. So there is a significant exposure to those tech names. So when those tech names have steep declines, it has a drastic impact on the index for certain. So something to be aware of. Beyond that, most advisor portfolios right now are overexposed to the U.S. There's about a 75% exposure to U.S. equities, and that's somewhat problematic just because we know what the impact for clients can be when they don't have enough diversification. So again, we need to broaden their level of diversification of portfolio. Last but certainly not least, I'm not going to spend a lot of time here, but we obviously know that inflation is having a significant impact on the returns of different vehicles. As you can see from the slide, we know that if the gross rate of return of a 60-40 right now is about 5.3%, roughly speaking. That still puts us deep in the negative in terms of real return when compared to inflation. So again, we need more upside potential, but we need to do that in a risk-forward manner. So let's dive right into the analysis of our research and looking at accumulation FIAs as part of a portfolio. So just for everyone's sake, our underlying assumptions were essentially this. We had a participation rate of about 80% and an index cap rate of about 3.5. These are very, very conservative estimates. We did this on purpose, but what we did is we took a look at, basically a broad brushstroke across the FIA landscape, and this was pretty middle of the road in terms of the participation rate and the index cap rates at the time of the research. So those were our underlying assumptions. So if we look at, the actual case study that we started with, we had a client current age of 58, retiring at age 65, their initial portfolio of $1 million, and we ran over 5,000 Monte Carlo simulation return paths during our research. The starting portfolio is a 40-60 portfolio. That's 40 equities, 60 fixed income. Why 40-60? Well, BlackRock's optimal retirement portfolio, the one that our LifePath retirement target date fund is based off of, is a 40-60 portfolio. So that was our starting portfolio for our research, again, for generally more conservative investors. When we looked at the FIA funding exercise, the FIA is funded from equities and fixed income. The breakdown was 30% in the FIA, 45% in fixed income, and 25% in equities. And when we looked at the FIA funded from fixed income, 30, 30, 40, respectively. So what were our key findings? Our key findings were essentially this: an FIA allocation offers greater upside than the median scenario when suitably funded. That means your middle of the road median returns, or the 50th percentile. If you look at the FIA allocation, it can reduce extreme bad outcomes or left tail risk in balanced portfolios. The FIA has improved worse and median outcomes for conservative and cash-heavy portfolios, assuming that liquidity needs had been met, and incorporating an FIA with an underlying vol-controlled index can help provide more certainty around future portfolio values. So let's dive right into the case studies. But before I do that, what I want to just parse out is a couple of things. We modeled everything on a 7-year chassis. Again, that was kind of about average when we looked at the entire FIA industry. But what we're looking at here is, with a 30% allocation to an FIA during bull markets, you saw a roughly 3% decrease in terms of the overall total return of the portfolio. The reason being, you're capped on the upside. The FIA products are not meant to keep up with the equity markets, so your account balance is certainly not going to grow at the same pace or achieve the same level of total return that your portfolio just invested in a market-based portfolio would. That being said, with that same 30% allocation to an FIA in a bear market scenario, there was a 13% improvement in the overall portfolio total return, because zero is your hero. You did not lose as much money, and so the overall client experience was significantly better in those bear market scenarios. So this is kind of the give and the take, if you will, of the research. So the first scenario that we took a look at is a client that is concerned about their portfolio and whether or not it'll provide enough upside potential for an adequate retirement. And so what we did is we took a look at that 60% allocation to fixed income, not being able to generate the return potential that they need in order to grow the portfolio. And so we looked at a couple of different scenarios, and with a 30% allocation to the FIA, there was an $18,000 increase in the median returns of that 50th percentile of returns, meaning the client's median outcome was significantly better when you sourced from fixed income investments to suitably fund an FIA. The next case study we took a look at is a client that was focused or nervous about extreme market volatility, downside market risk scenarios, and less focused on growth. So what they wanted to do is de-risk their portfolio in the event that we have a scenario like we did this year, where we've had the S&P is down 16%, the Barclays Ag is down roughly about 9%. So we're trying to eliminate that left tail risk in a portfolio and what could really have a detrimental impact to the overall success of the client's retirement. So what we took a look at is, again, that 30% allocation to FIA products, but we looked at the lower bound. So that's the extreme left tail, or the fifth percentile of outcomes, meaning that 95% of the time, the returns were better than this percentile. But in that extreme lower bound, what we found is that there was a $61,000 increase to that same portfolio, meaning that their lower bound outcome was significantly better than our Monte Carlo return paths when you look at using an FIA that's funded from both equities as well as fixed income to eliminate that left tail risk. The last scenario that we took a look at is cash-heavy portfolios. Those more conservative investors. Your typical CD fixed annuity client. That just holds on to a lot of cash because they're very nervous about the overall markets. The challenge, obviously, we know is that with cash-heavy portfolios, is that inflation, you're roughly in the negative about, let's call it 8%, 8.5% year to date in terms of real return because of inflation, and this could certainly eat into their assets. It's not only inflation, it's the price of gas, the groceries, so on and so forth. So what we wanted to take a look at is, if we sourced an FIA from cash and fixed income, if we can improve both the worst and median expected outcomes. So on the left-hand side of the page here, you can see with a 30% allocation to an FIA, there's roughly a $24,000 increase in the lower bound, those worst outcomes for those cash-heavy portfolios. It's a substantially better outcome versus sitting in cash at the lower bound. And at the median level, we looked at a $19,000 increase with a 30% allocation to FIA assets. So in cash-heavy portfolios, not only was your lower bound, improved upon significantly, but so was your median return. So overall, the client was substantially better off in almost all of these scenarios when utilizing an FIA as a holistic portfolio construction tool. So one of the things I forgot to touch on, I'm just going to take a step back, is why a 30% allocation? Well, if we look at most compliance departments across broker-dealers, wirehouses, banks, so on and so forth, they only allow about a 30% allocation to annuity assets, maybe slightly higher depending on the broker-dealer. So we use kind of 30% as just a base case for, to gobble up the majority of, what is allowed into FIA assets from a conservative standpoint. The last place we're going to take a step on here is looking at vol-controlled indices as part of an FIA. As you can imagine, BlackRock is in the business of building indices for FIA products. We actually have a really, really unique one on the Lincoln platform. So what we wanted to take a look at is, what are the benefits and the trade-offs of utilizing these vol-controlled indices in a portfolio? So when we look at the benefits, by utilizing vol-controlled indices, you have the ability to gain more confidence about future portfolio values, and your return distribution is much narrower, meaning you have more consistent returns and positive outcomes between the floor and the cap on a regular basis. It also allows for the participation in extreme market moves that are positive with a par rate strategy. However, obviously, we know that there's going to be a little bit of cap on the upside, so it's not going to obviously keep pace with what overall equity markets do, but you're going to be you do have the ability to participate in some of those extreme market moves on the positive side. The trade-off is being that, again, you're kind of capped in terms of what you can achieve on the upside. So, the built-in vol control cuts off both tails of the return distribution, obviously, certainly on the left side from the extreme bad outcomes, but also in the extreme positive when you've got, just say the S&P at a 30% RIP, you're not going to capture the full upside of that market move just because the product is not designed to allow you to do that. The other trade-off is that there is a proliferation of options across the entire FIA indice, and each one of these, vol-controlled indices is different in the way that it functions, its overall objective, how it's constructed. So there's a ton of options out there, which is why clients need to lean on their trusted advisor to help navigate what would be the best and most suitable option for them. So the key takeaway here is that there should be an active discussion between the advisor and the investor. These conversations should consider the product design, index design, current cap and par rates, median outcome expectations, and the desired confidence around target outcomes. Going back to my FIA wholesaling days, if you could average somewhere between 4 to 6% for an FIA, you were doing great. You effectively were replacing the traditional return of bonds without the downside risk that fixed income presents in a rising rate environment. And if you were going to do better than that, 5 to 7 or better, you're crushing it. So you have the ability to achieve both. It's just kind of a active discussion that you need to look at when discussing with your client. So to conclude, an FIA can offer greater upside in the median scenario when suitably funded. The FIA allocation may reduce extreme bad outcomes in balanced portfolios. And for conservative and cash-heavy portfolios, FIAs may improve worse and median outcomes, assuming obviously that those liquidity needs have been met. And by incorporating an FIA with an underlying vol-controlled index, you can help provide more certainty around future portfolio values and consistent returns over time. So let me just pause there. Happy to answer any questions, comments, concerns with regard to the research, if anybody's out there and has any.
Yeah, question came up. So, based on what bonds are doing this year, they're down about 10%. And, that shows, the need for, those safe dollars to go into the index side of the business where your floor is going to be with 0. And would you suggest, more of a, 40% number of their investments in FIAs, as you get older, does age have, a little bit to do with how much you want to have in FIAs versus, bonds and stocks?
I mean, again, we did take a look at those scenarios, and as you saw from most of the charts, there was obviously a better outcome in our research. But again, what it's going to boil down to is the suitability at the client level and whether or not that's an appropriate investment for the client based on, their time horizon, risk tolerance and overall financial goals. And that's something, that needs to be discussed at the advisor client level. So we don't have any particular comment in that regard, but our research did obviously show, based on the charts, that with that 40% allocation, it obviously meant, better outcomes for clients.
Right. Another question came up, kind of with what's going on this year in the market and, the overall scenario with what's going on in the U.S. You guys expect the stock market to have, a decent return through the end of the year? I mean, obviously not getting back maybe all the losses, but you guys expect to see a swing in the market back to the favor side of it, things going up?
So here's what I'll say is my capital markets outlook has effectively changed on a week by week basis for the last 6 weeks. Craig can tell you that over the course of doing these calls the last 6 weeks, it's been different each time we've done these. So when we started out the year, at the beginning of the year, that we were expecting, high single digits, low double digits for equities, meaning U.S. stocks. At this point in the game, I think we're going to probably, if we end up, flat for the year, that would be a significant move. What's really been driving the equity markets is the strength of the U.S. consumer and their ability to spend and to continue to drive and grind the economy higher with consumer spending. But with inflation running at 8.5%, that's really starting to have an impact on that consumer spend level. And obviously when we're paying, I think it's like $4.70 a gallon as a nationwide average for gas, that really has a severe impact, not only on the consumer, just from what they're paying at the pump, but also in a variety of other parts of their life, the cost of groceries, things of that nature. So when you parse inflation, with some of those other headwinds, you get to a certain point where if it continues to go further in one direction, that consumer spending level is going to have to decrease, just because their income that they can spend on various different things in the economy is obviously going to be impacted because they're focused on just essential spending needs.
Right. You guys expect the interest rates to kind of level off now, and we've seen a little bit of actually a decrease in rates the last maybe week. You guys expect that trend to continue, where rates start dropping again?
The answer to that, I think, is no. The Fed is likely going to probably have to raise rates again because they have to get inflation under control. The problem that we're going to run into is the Fed's going to have to raise rates again. At this point in the game, I would expect it's probably either a 25 or 50 basis point increase at the next Fed meeting to try and, stamp out the inflation that we're experiencing. The problem is, if you think about the economy, it's like an engine that's overheating, but it hasn't started to putter, before it shuts down yet. So we haven't completely overheated it to the point where the engine's going to shut down, but the economy is running extremely hot, and the Fed's going to have to probably likely increase rates in order to kind of tamper inflation.
Okay. I think that's all I had for you this morning. Questions on that. Otherwise, we appreciate your time, Ryan. I know you have to get to another meeting, so appreciate you joining us today. Great information you shared with the group this morning. Anything you want to finish up with here this morning before you head out?
Yeah, last thing I'll touch on is, we have a great index. It's very unique inside of the Lincoln OptiBlend product. It's the dynamic allocation portfolio. It is actually built in partnership with our global allocation team here at the firm, which is one of the largest and most well-resourced and well-respected teams at BlackRock as a firm. You've got a broad-based, diversified portfolio that has some unique exposures to like gold, real estate, as well as tips, which was included in the portfolio as like a break glass in case of emergency part of the portfolio, and has obviously paid off in this particular environment. So it's a phenomenal portfolio. Take a look. I think it pairs very, very nicely with some of the other indices that are on the Lincoln platform, which Craig will obviously get into here momentarily. But that's kind of where I leave it. Again, I really appreciate your time, your partnership, your business and support, and anything that we can do in partnership with IAMS and Lincoln, we are obviously happy to do, and really appreciate the time.
Sounds good, Ryan. Appreciate your time this morning. Have a great Memorial Day weekend, and we'll go ahead and kick it back to Craig here. Craig, I've got a question that came up. What's the maximum issue age on your indexed annuities now at Lincoln? I had that come up a couple times.
85.
85. Is that on your what duration? Is that your 5-year and 7-year?
That'd be the 5 and 7 year, and it's age 80 on the 10-year.
Okay. So hope that helped that individual out here based on the age max. I know you guys have really been bumping rates up, and has that had much of an effect kind of where monies are going right now based on, the indices? Have you seen more money heading into one indice versus another based on these rate increases?
Yeah, typically what we've seen in terms of trends, we're definitely seeing people allocate to the S&P cap as well as our S&P 500 daily risk control strategy. That's kind of a unique index to Lincoln. It's obviously uncapped. It's got a spread, no bonds in the index, dividends included. But there's definitely been a lot of traction toward the BlackRock index. I think people are looking for a good diversifier within an index annuity product. And because it has so many unique features and benefits to it, it's certainly something that seems like it stands out with advisors right now.
Sure. And I just launched a quick poll. People that want to get more information what Lincoln has to offer on their portfolio, I just went ahead and kicked a quick poll on that. So if you have interest in getting more information on what Lincoln has on their OptiBlend series, I know that's their top selling series right now, be glad to get you the details on the indices that make up that and kind of what's going on with that. Are you seeing more shorter term indices being sold, say in a 5-year chassis or a 7-year chassis? Is that trend kind of hitting you guys at all, Craig?
We are seeing that. I think for a lot of people that are unsure about what's going on with the market, they're concerned about fixed income, they're looking for a place to kind of de-risk the portfolio, and we're definitely seeing a trend toward more on 5-7-year business as of late.
Mm-hmm. And your 5-year rates, are those the same as the 7-year now? Have you guys kind of gone to across the board on the 5
Correct.
and 7-year the same?
Correct.
So you have a 7% cap, do you not, on a index annual point to point cap?
That's correct.
Right.
And the S&P 500 daily risk control strategy, the one that I mentioned, doesn't have bonds in it, so it's kind of like a nice true bond fund alternative, but it does include the dividends. The spread on that is only 25 basis points.
Mm-hmm.
So that's what the spread is. So it's
Right.
significantly lower than it was just a couple weeks ago. And to your point, that when you look at the BlackRock index, the BlackRock index, by the way, comes in three flavors. It comes in a 1-year par and a 2-year par, with no fee. And then there's also something we launched in the last couple of months called Par Plus. That's an option where you can buy up the par rate with the BlackRock index on the 1-year par for a 1% fee. So that is also available on our product.
Right. How much does that increase it? Does it go up by a pretty big percentage on that side of it if you do buy it up?
It's pretty significant in terms of how much more it buys up. Correct.
Right.
Yep.
Right. Well, that's good. And then your contracts have money available in the first year, correct? You have a 10% available in the first year on your contracts there.
Correct.
And then any other highlights you want to hit this morning, Craig, on your end, since you have me on the phone?
No, I think we definitely touched on all the highlights there. Like I said, Lincoln's very much in the accumulation marketplace. That's kind of where we are focused on this year, and I think we're definitely competitive across the board. And to Matt's point, we had a pretty significant rate increase last week on the 17th, and yeah, I definitely would recommend just checking out our rates and checking out our various indices. I think we got a lot of good differentiators in terms of index strategies and pricing on our products today. So I just want to thank
Right.
everyone for their time.
You got it. And then what's your fixed rate right now on that 5 and 7 year contract on the Opti bond?
Oh, yeah, thanks for bringing that up. Yeah, for someone who's not unsure about wanting to go into an index strategy right away, because of all the volatility and all the noise going on, that fixed rate right now is 3.5%. So when you think about what bonds are doing right now, and they're negative, and CD rates are atrociously low, and if they want to go into cash, that's going to be even worse with inflation at 8.5%. Definitely something to consider there if you're looking for a place to put the money, at least in the initial first year, if they don't want to go kind of in the market right away. So definitely something to consider there.
Yeah, I've been seeing a number of clients wanting to go with maybe a 50-50, 50% in their fixed account, 50% in the S&P, and that's been pretty consistent the last couple months based on kind of the way the market's been going. And of course, right now is also obviously a good time to get in when the stock market's a little bit lower on values. Good time to ride that wave back up once it starts going back in the upward direction. But I know Lincoln's been very aggressive with their rates, this last couple months, and we're definitely seeing a trend, with Lincoln on some really nice rates on their availability of returns, coming up down the road. And we'll probably see that continue the next couple months based on the rates being offered. But appreciate you joining us this morning, Craig. Great information. Appreciate you getting Ryan on board with us from BlackRock. He did a great job on his presentation. I'll be giving everyone a call today and tomorrow that did attend today's meeting. I'll go ahead and forward the information that Craig's going to send me on additional documents that he thinks you definitely want to take a look at on what Lincoln has to offer there in the field. And once again, everyone have a very safe Memorial Day weekend. Enjoy hopefully warmer temperatures than we're having here in Omaha today. But anything you want to finish with there, Craig?
No, I just want to thank everyone again for their time, and hope everyone has a great holiday weekend.
You got it. Otherwise, everyone have a great week. And any questions you have, this is Matt. Toll-free number 800-255-5055. Be glad to answer any questions. I'll be giving everyone a call, as I mentioned, today and tomorrow to review what was discussed today, and we'll see if we can't get you on board with Lincoln Financial. Otherwise, everyone have a great week. Bye now.